There is a quiet machine moving your money, whether you understand it or not. Most people never see it. They think the stock market is one big pile. They think money goes in, numbers go up, and if the index is flat, then nothing important is happening. That is not how the game works. Money is rotating all the time. It is leaving the sectors everybody is staring at, and it is slipping into places most retail investors never even bother to look. That is one of the oldest advantages in markets. The crowd looks where the lights are brightest. The serious money looks where the next pressure point is forming. If you miss that rotation, you can spend the next year owning the same crowded names everyone else owns, watching the index grind around, while a small pocket of stocks quietly does all the real work. If you catch it early enough, you do not need meme stocks, you do not need hero trades, and you do not need to gamble. You only need to understand how capital actually moves. I want to walk you through that the way I would explain it to someone I care about, not with jargon, not with cute slogans, and not with the fantasy that the market rewards effort equally. It does not. The market rewards people who learn where the money is going before the crowd feels safe enough to admit it. So let us start with the biggest misunderstanding of all. Most people think this is still a market where buying almost anything sensible is enough. That was much closer to true in easier years. In periods like that, liquidity rises, enthusiasm spreads, and everything with a ticker starts looking brilliant. People confuse a rising tide with personal genius. Then the weather changes, and suddenly ownership matters more than timing. Not when you bought what you bought, why you bought it. What part of the chessboard you are sitting on while capital is moving somewhere else. That is the world we are in now. Inflation has not fully gone away. Interest rates are not dropping in the clean, easy way people hoped they would. Governments are running large deficits. Central banks are still part of the story. Geopolitics is part of the story. Energy is part of the story. Supply chains are part of the story. A lot of people hear all of that and freeze because it sounds too broad and too messy. I do not think you need to predict every storm cloud. I think you need to understand the season you are standing in. I have always liked simple mental models. Think of the market like weather in one season. Growth at any price can flourish. In another season, capital gets defensive. In another, hard assets start to behave differently. In another, the picks and shovels businesses that support a larger trend become more attractive than the glamorous names everybody is talking about. Your job is not to guess the weather with perfect precision. Your job is to dress for the weather that is already here. And the weather here is not the easy, indiscriminate environment people got spoiled by. This is a market where the biggest companies can keep getting bigger simply because the plumbing of the market is designed to keep buying them. That plumbing matters more than most people realize. Take the S&P 500. Most people hear that name and assume they own a beautifully balanced slice of American business. What they really own is a heavily weighted machine. The index is market cap weighted. The bigger the company, the more of the index it becomes. The more passive money flows into the index, the more of that money is automatically pushed into the largest companies. That means billions of dollars are not making fresh judgments every day. They are following a formula. If one giant company is 10 times bigger than a smaller one, a passive buyer sends 10 times more money into the giant, then more passive money arrives. And the giant gets another forced purchase. That is not a conspiracy. It is simply how the mechanism is built. It creates a flywheel. The largest companies attract flows because they are large, and they become larger because they attract flows. A lot of investors tell themselves they are diversified because they own the index. In many periods, what they really own is a concentrated bet hidden inside a diversified wrapper. If the mega caps are leading, it looks brilliant. If the leadership changes, they suddenly discover they have been standing on one side of a seesaw without realizing how broken it was. I do not say that to scare you away from indexing. There are times when indexing is sensible, but I do say it so you stop telling yourself that passive ownership means you are neutral. You are not neutral. You are heavily exposed to where passive money is already concentrated, and if you understand that, you can begin asking a much better question. Not which famous stock should I chase next? Where is money starting to move that the crowd is still ignoring? That question leads to a very different process. My process is simple enough to remember and strict enough to keep me out of a lot of foolish behavior. First, I map the broad weather. I want a plain English view of the world. Are we in an environment where energy security matters more? Are government spending more on infrastructure? Are supply shortages becoming strategic instead of temporary? Are real assets gaining importance? Are the fashionable growth trades crowded and expensive, while neglected industrial businesses are quietly improving? I do not need to know everything. I need to know enough to identify where large money might have a reason to move. Second, I rank sectors. I do not begin with individual stocks. That is how amateurs behave. They fall in love with stories before they understand the river. The story is floating on. I want to know which sectors are getting tailwinds, which ones are attracting capital, which ones are benefiting from broad forces instead of one clever headline. The sector comes first because a weak business in a powerful current can still move, and a good business in a dead sector can sit there doing nothing while you congratulate yourself on being early. Third, after I know the weather and I know the sectors, then I look for leaders inside those sectors. I want the names institutions are likely to prefer. I want the businesses positioned near the center of the trend, not on the fringe where the story is exciting, but the economics are fragile. That is where discipline begins to matter. Now let me bring this out of theory and into something useful. There are two areas I would watch very carefully in a market like this. And what interests me about them is not that they are exciting. It is that they fit the logic of the rotation. The first area is the picks and shovels side of oil, gas, and energy infrastructure. When most people think about energy, they jump straight to the producers. They want the pure oil story. They want the dramatic commodity. Narrative, I have never thought that is the only way to make money around a large trend. During any rush, the people selling equipment, tools, processing capability, maintenance, and infrastructure can do very well because they are tied to the build-out itself. That matters now for several reasons. The world still needs energy in enormous quantities. Artificial intelligence is not reducing energy demand. It is increasing it. Data centers are power hungry. Grid upgrades require capital. Natural gas infrastructure still matters. LNG still matters. Drilling and processing and transport still matter. Add geopolitical tension, damaged or threatened supply routes, and an increased obsession with energy security. And you get a world where the supporting machinery businesses can quietly sit in a very attractive position. This is what I mean by following the money instead of following the noise. You do not need to make a heroic call on the exact next move in crude oil to understand that more drilling, more maintenance, more LNG capacity, more storage, more transport, and more domestic infrastructure all require equipment and services. That is why names like Baker Hughes deserve attention. I am not saying a ticker is magic. I am saying the business sits in a useful place on the board. It sells the tools and services that keep complex energy systems operating. In an environment where producers are spending and infrastructure is expanding, that positioning matters. It is the kind of business that benefits when the industry must keep building, regardless of whether retail investors can explain the macro story in a polished way. A smaller name like NPK is interesting for a related reason. It is not the same scale. That is precisely why it sits on watch lists differently. Smaller firms tied to worksite infrastructure, construction support, and energy projects can begin to attract institutional interest when a sector gains momentum and investors move down the chain from the obvious giants to the more focused beneficiaries. That is often how rotation matures. First, the broad theme gets bought. Then the supporting names begin to move. I have seen this pattern many times. The crowd thinks in headlines. The institutions think in supply chains. The crowd wants the dramatic winner. The institutions ask who sells essential equipment into a business that now has more money to spend. That is a much better question. The second area I would watch is critical minerals, rare earths, lithium, uranium, and the businesses tied to strategic material supply. This area looks boring to many people right up until it stops being boring. Then everybody suddenly pretends they always understood it. The reason I care about it is straightforward. The modern world is becoming more electric, more data intensive, more energy hungry, and more strategically paranoid. Those forces all increase the value of secure mineral supply. Electric vehicles need materials, grid modernization needs materials, battery storage needs materials, defense systems need materials, advanced electronics need materials, AI data centers need power, cooling, and physical infrastructure, which ultimately means more demand for industrial inputs. On top of that, governments do not like relying on unstable or rival jurisdictions for strategically important materials. Once a resource becomes national policy, the investment case changes. That is why a lithium producer like SQM gets attention. It sits inside a chain the world is still trying to expand. The exact path will not be smooth. Commodity businesses never are. But the larger point is that a company tied to an essential input for electrification and storage can benefit when the capital cycle turns back toward real inputs instead of pure software dreams. Uranium is a different but equally revealing case. For years, people treated nuclear power like a political embarrassment. Then power demand rose, energy security became serious again. And the conversation started changing. AI did not just create a technology story, it also created an electricity story. And once electricity becomes the constraint, nuclear stops looking theoretical and starts looking practical in that world. A name like Uranium Energy Corp enters the conversation because domestic supply begins to matter in ways it did not a few years earlier. Then you have businesses connected to rare earths and other strategic minerals like CMP. Again, I do not care about the excitement. I care about positioning. If countries want to rebuild domestic supply chains, if industrial policy starts backing strategic extraction and processing, and if capital rotates into the area before the public has fully noticed. These are the sort of names that can start acting differently from the index. Now, let me be very clear. Watching a sector and buying a stock are not the same act. A great many people ruin perfectly good ideas by turning them into impulsive trades. I have no interest in that kind of behavior. If a sector thesis is right, you do not need to bet your life on the first tick. You need to manage risk, size positions sensibly, and understand that your first responsibility is survival. I have always believed that if you cannot sleep at night because of a position, the position is too large. That sounds simple because it is simple. Most investors do not lose because they never have good ideas. They lose because they use too much leverage, they size too aggressively, or they concentrate in a way that makes one mistake fatal. In a market like this, I would rather have a process than a prediction. Position sizing matters. Diversification across a small set of high conviction areas matters. Patience matters. Scaling in matters. You do not need to dump your money into a theme you only understood yesterday. You can learn, watch, build your view, and move gradually. There is another thing I want you to understand because it changes how you see the entire market. Money does not vanish nearly as often as people think. It rotates. It moves from one square of the board to another. One quarter, it may crowd into software. Then it leaks into defense, then into energy services, then into insurance, then into miners, then back to quality compounders. The point is not that one theme wins forever. The point is that capital is always choosing. Most retail investors stare at the same handful of mega caps because those names dominate the financial media. That is like standing in one busy train station and concluding nothing is happening anywhere else in the country. The serious work is not staring harder at the obvious. It is learning to notice where the next wave of capital has a reason to go. That is why I return to the same phrase again and again. Follow the money. Do not follow the noise. Do not follow the excitement. Do not follow the name everybody already knows. Follow the money when the macro weather changes. Money looks for sectors that fit the new climate. When passive concentration becomes extreme, some investors double down on the giants, and some start hunting the neglected corners, where a small inflow can change the whole picture. When real assets, industrial capacity, energy security, and strategic materials matter more, the beneficiaries change, and if you are still mentally living in the old season, you will miss it. There is a dangerous habit I see all the time. People tell themselves they are being safe because they are doing what everyone else is doing. That is not safety. That is social comfort. Real safety comes from understanding what you own, why you own it, and how it fits into the forces now shaping the market. If all you own is the same crowded exposure every other passive investor owns, then your outcome is tied to that concentration. If that concentration keeps working, fine. But if leadership broadens, or if capital begins rewarding real assets and industrial capacity more than narrative glamour, you will discover too late that convenience is not the same thing as strategy. So what would I do if I were looking at this board right now with fresh eyes? I would begin by admitting that this is no longer a market where owning everything equally tells you enough. I would study where passive concentration has become extreme. I would ask which sectors are unloved but improving. I would focus on areas where the world is being forced to spend money, not where investors merely hope sentiment will improve. I would build watch lists around energy infrastructure, oil and gas services, LNG exposure, uranium, lithium, rare earths, and other strategic mineral plays. Then I would narrow from there. I would not confuse a good story with a good business. I would not confuse a good business with a good entry. I would not confuse one correct thesis with permission to overbet. And I would never forget that the market rewards discipline long after it stops rewarding excitement. The most useful investors are not always the ones with the smartest vocabulary. Usually they are the ones willing to sit quietly, observe the rotation, and move only when the setup is there. They understand that a stock is not just a ticker, it is a place where capital, narrative, economics, and timing are meeting. If one of those pieces is missing, you can still end up stuck. That is why I care about sectors before stocks. The sector tells me whether the wind is at my back or in my face. The stock only matters after that. You do not need to be first. You do not need to be clever. You need to be aligned. And if you remember nothing else from this, remember this. The index is not the whole market. The loudest stocks are not the whole opportunity set. The biggest money in the market is not sitting still. It is rotating quietly, methodically, and usually before the public narrative catches up. If you spend the next year staring at the same crowded names everyone else is staring at, you may still do fine. But you may also miss the last big wealth opportunities that come from being early to a real rotation instead of late to a popular story. I would rather own businesses sitting where the world has to spend than fantasies sitting where the world merely hopes. I would rather own picks and shovels in a build-out than slogans in a bubble. I would rather watch the flow of capital than argue with headlines. That is how I would think about it. Not predict everything. Not gamble. Follow the money. There is one more reason this matters so much. Now, the people who control large pools of capital are not emotionally attached to your favorite sectors. They are attached to performance. If a theme has become overcrowded, expensive, and vulnerable to disappointment, they will not sit there out of loyalty. They will trim it, rotate out of it, and put that money where the next imbalance is more favorable. By the time television explains the move, the first leg is usually over. That is why education matters more than commentary. Commentary tells you what happened. Education gives you a framework for seeing why it happened and where the next move may come from. I also want you to understand why this way of thinking is more responsible than blindly hunting hot tips. A tip makes you dependent on somebody else's conviction. A framework makes you independent. Once you understand the weather, once you understand the sector ranking, and once you understand how leaders are selected inside those sectors, you stop behaving like a tourist in markets. You begin behaving like an owner of capital. That change in posture matters. The market punishes dependency. It rewards people who can think in systems. That is one reason I've always liked businesses that sit inside unavoidable economic flows. Human beings can debate narratives forever. But when a country needs more power, more pipelines, more processing, more storage, more grid reliability, more domestic mineral supply, and more strategic resilience, money will go somewhere. It may not go in a straight line, but it will go somewhere. I would rather study the map of that necessity than chase whatever story has the loudest momentum on a given Tuesday. This is also where patience becomes a competitive advantage. You do not need every idea to work immediately. Some sectors spend months doing very little while the fundamentals keep improving underneath the surface. That frustrates impatient people. But it is often where the best asymmetry lives. The crowd wants proof before it buys. Institutions often begin accumulating while the proof is still incomplete. Then, once the chart improves and the thesis gets easier to explain, the crowd arrives and calls it obvious. It was not obvious. It was simply visible to people who were watching the right things. And let me say something plain about risk. There is a big difference between concentration and conviction. Concentration says, I am sure enough to bet heavily. Conviction says, I understand this well enough to build exposure. Thoughtfully, most people confuse the two. They feel conviction and they express it with concentration. Then one setback turns a sensible thesis into a painful lesson. I would much rather own a basket of carefully chosen exposures around a strong macro current than pretend I know which single name will dominate every quarter of the story. That is especially true in themes like energy infrastructure and critical minerals. These are real businesses in real cycles. Commodity prices move. Governments change policy. Projects are delayed. Costs rise. Demand forecasts swing. You do not solve that uncertainty by becoming more emotional. You solve it by being sane about position size and by demanding that every investment fit inside a larger process. People who last in markets are not the ones who avoid uncertainty. They are the ones who refuse to let uncertainty dictate reckless behavior. If you are a retail investor and all of this feels more serious than what you usually hear, good serious is appropriate. You work too hard for your capital to treat investing like entertainment. The point is not to make every week exciting. The point is to compound capital over time without blowing yourself up. If sector rotation helps you do that, use it. If it helps you avoid overcrowded trades, even better. If it helps you notice that the real opportunity is not always where the cameras are pointed, then it has already done more for you than most market commentary ever will. I have spent enough time around markets to know that the game always looks easiest right before it gets harder. That is why I prefer methods that force me to think about where the pressure is building. Right now, I see pressure building in the businesses that support energy production, energy transport, and energy security, and in the materials businesses tied to electrification, nuclear power, strategic supply chains, and industrial sovereignty. Maybe every name in those areas will not work. That is not the claim. The claim is that these are the places where I believe investors should be paying much closer attention than they are. And if you do that consistently, if you keep asking where capital has a reason to move next, where forced spending is emerging, where a neglected sector is becoming strategically important, and which businesses are leading inside that space, you will already be operating on a level far above the average participant. Not because you know the future, because you finally understand that the market is a living allocation machine, not a popularity contest,